Cool. So today we're going to talk about mortgage and real estate financing. Obviously, the real estate industry wouldn't be what it is today without the mortgage industry. I mean, it's it's a lot of money to buy a house, and the banks are, worked out an institution where they're taking a leap of faith based on people's qualifications and giving them significant amounts of money. So the mortgage industry is certainly a huge component to what we do. So it's important that you understand the basics of the mortgage industry for a number of reasons. You want to understand, how what's going on in the mortgage industry can affect what's going on in the real estate industry as a whole. And then you want to understand, the mechanics of loans and the different types of loans, because that's going to help you be a better resource to your client. Like a lot of the other things that I talk about, you need to understand. You need to understand it at a general level, and you need to be able to talk about it intelligently. But you don't want to go too deep into things, because that's what you have the experts for. So really, like, you want your knowledge base on this topic to be enough that you can understand people's questions, and then know what direction to point them in, or be able to answer some of the higher level questions, and then use that as an opportunity to connect them with professionals. So I know I hammer on that all the time, but that's something, as you develop in this career, the ability to be able to speak to a lot of topics, but also defer to the experts, is just going to make you a better resource, because there's so many facets of what we do, whether it's the homes themselves and all the things that go along with inspections and construction, whether it's the title and escrow, whether it's the tax implications, and or like we were talking about 1031 exchange last week, or whether it's the financing. And obviously the financing is the biggest one of all, because that usually starts the process. So we're going to go through a lot of the basics of the process and the different types of loans. I think this is one where, even if you've done a handful of deals, I'm sure you still have some questions. So if you do have some questions, feel free to drop them in the chat or jump in, because there are probably questions that can help everybody. So just keep that in mind this time. We're definitely open to some questions as we go along, especially once Patty jumps on at 11. It skips too fast. So I don't know. I feel like the slides look good with a quote in the beginning, and there's different variations of this quote. I was trying to think of something I'm going to say about mortgages, and this is something that, as cheesy as it sounds, and I usually preface it with, I know it sounds cheesy, but this is something that I tell to potential buyers, because unless the property's owned free and clear, there's a mortgage on it. And so if you're paying rent, you're paying a mortgage either way. So you might as well pay your own. And it really sometimes resonates with buyers, especially in this market where rent payments are often higher than what the mortgage payments are, and that's how landlords are making money. So really, like, understanding the financing part and understanding how to talk to people, especially when they're really early on in the process, will help push them towards the decision of making a home or buying a home, because a lot of people think that the financing part is a hurdle that they can't overcome. But if you get them to think about it in terms of that they're already paying rent, and the rent expense is, often, if they can afford the monthly rent in this area, they can afford a mortgage payment if they can just figure out a down payment, or make a plan to do that. So getting buyers to wrap their head around the monthly payment of a mortgage and how doable it is really the first step in getting somebody that's going to be ready to purchase a home. So figured I'd start it with that cheesy quote, but I use it all the time, and it definitely resonates with buyers. Before we dive too much into the process, and before Patty gets on, one thing I want to talk about is just the importance of relationships with your mortgage lenders. I always talk about how you want to develop a team of experts around you that you can lean on as resources, as things come up. And number one on that team is a mortgage lender. And really, you want to have multiple mortgage lenders, but we've talked about it before, and other agents have talked about, you have a lot more leverage when you send a certain partner a lot of business. So if you have, the longer you are in this business, the more you should really focus on developing a strong lender partner. Not only is it good for business in that, if you're referring a lender business, then a good lender should be referring you opportunities. They have sometimes less opportunities to refer to you than you might to them, but they still will if it's going both ways. But it also will make your job easier because the level of communication with a good lender partner will allow you to just operate a little more agile when you're out in the market. So my lender partners, I use Kayla and Deanna with Alameda Mortgage. I've been using them for about a year and a half. We've done, this year worked out to where the majority of my buyer deals were with them. And it just makes life so much easier when you're really comfortable and really confident in the relationship you have with the lender and the level of communication. Because one, you want to make sure that what they're telling you is accurate, and that they're not going to put you in a position to where the information you have maybe isn't the best information. Because sometimes, a lender will just, not that they're outright deceiving you, but they'll try to skew things to tell you what you want to hear because they want you to use them, and then you get in a contract and it turns out they're not as fast as they are, or they're not as communicative as they should be, and it just jams you up. And really, and I'm sure there's experienced agents on here that will say the same thing. Like, some of the most stressful situations that I've been in when it comes to like being in the middle of a transaction and the clock ticking towards close, and being in a position to where, the listing agent's pressuring you for something, and it's things are going a little sideways. A lot of the times it's because a lender, I don't want to say screwed up, but there's an issue with the financing. Because once you're in escrow, every day is critical, and if lenders aren't super proactive and on top of everything and looking for potential pitfalls before they come up, you could be in a situation where you need a few days to clear something up, and you're supposed to be funding a couple days from then. So really being in a situation to where when you are in those tough spots, you're confident that the lender that you're working with is doing everything possible to resolve it. And then also honestly, just the basic communication. Like, if your lender isn't calling you back in a timely manner, that's obviously a huge red flag. But also, this business is, for better or worse, 24/7, and lenders should be like that on their end too. So if you have you're working on developing a relationship with the lender, but you don't feel comfortable texting them, in the evening or on a weekend or at an odd time, like that's something that a good relationship you should have. And obviously that's not something you abuse. And like, I only reach out to my lenders at odd times, or desperately when I really need it, and they know that. So they know if I'm calling them at 8:00 on a Sunday, there's a good reason that I'm calling them 8:00 on a Sunday. And it goes both ways. So really just want to stress the importance of developing a relationship with lender. And even as new agents, you might not have much business then. Like, lenders and vendors in general that are looking for real estate partners. I mean, as a real estate agent, you're the premier person driving the business of the transactions. So a lot of lenders will look to new agents to develop those relationships early on, because it's easier to develop a relationship with a new agent based on the faith that they're going to start generating business as they get up and running, versus trying to, pull somebody away from a lender that they've been working with for years and is doing a really good job. So basically, like, you want to feel like the lender is you're an attractive, you're good, talking to you is a good use of the lender's time. Like, if you feel like the lender is blowing you off or not taking the time to answer your questions properly, that's not something that you really need to or should put up with, because there's just like there's a lot of good agents, there's a lot of good lenders. So if the lender's not providing a level of service that you're satisfied with, then you should find somebody that is, or find a way to work it out with that person to where you are happy with the relationship. So that's pretty much it. Does anyone want to kind of chime in real quick on that topic of having a good working relationship with your lender? Because I really can't emphasize enough, like, how huge that is, and how much it makes you better at what you do. Walter, I see you unmuted.
Yeah. Hey, y'all. Obviously, most of y'all know I'm
Take your headphones off, Walter.
Boomer alert. What's up? Can you hear me now?
Yep.
Got me? All right, I'm 41, so be patient with me. So what I use the lender kind of in my limited experience is kind of like Batman or Robin or mom and dad. So the lender is going to get information from the client that you're not going to get. So I had a situation, the one I'm in contract in Pittsburgh, where they told me one budget, they told her another budget. The truth is somewhere in the middle. So I like to use the lender kind of get information that I can get or I don't want to ask. So it's like a hand-in-hand relationship basically to get information on top of all the financing and all the other stuff.
Totally. And that, yeah, and that's a good point. And that just further illustrates kind of what I'm saying is there's so many benefits to having a good relationship with your lender because it gives you advantages in a lot of ways, like in communicating with your clients and, different people are going to have different relationships with people. So like Walt was saying, sometimes your buyers will talk to your lender about things that they're not necessarily comfortable talking to you about. And that will help you kind of figure out the best way to approach things. And then that also goes when it comes to communicating with the listing agent. A good lender should call the listing agent. Obviously you got to ask them to and give them the information, but I have the lender call a listing agent when I put offers in. And sometimes, based on the questions, the listing agent might talk to the lender a little bit more candidly about offer. And, if they're asking about certain things, then, your lender could report back to you and that you might be in a better position. Like I've definitely gotten deals, or it's at least been a major factor because the lender, established a little bit of rapport with the listing agent, and that helped me kind of put myself over the edge or differentiate myself and my buyer as somebody that listing agent wanted to work with. So working with reputable lenders that are, have a good relationship in the market, or even if they aren't known, when they connect with a listing agent, they can, present themselves in a way that they're someone that they want to work with. Because like I was saying earlier, things can go sideways when a bad lender's involved. And if two offers are the same or really similar, and one is a lender that the listing agent has confidence in, and one is somebody that the listing agent has maybe had a bad experience with that company or that person, that individual, or just doesn't get a good feeling when they connect with that person, like that could cost you the offer. So who you work with is super important. There's a lot of good resources out there. But really, if you're new, talk to your colleagues, talk to me, Elias, Kenny, people that are doing deals, and ask them who they like, and kind of, do some research on your own, like essentially kind of interview a couple people. So when you do have those questions, you have somebody to reach out to, and then depending on how they handle that, like choose who you give your business to. I chose to have Patty on the call today. I mean, we don't necessarily steer people towards, certain vendors. We want you to make your own decisions, but Patty's making a big commitment in our team, spending $5,000 a month on leads. So to me, I mean, that shows how much she's committed to, our success and the faith that she has in our team. And we should, reciprocate that by giving her opportunities to show us what she can do and build that partnership. And if you were on that call yesterday, I had to jump early, but the 15 minutes that I heard her talk, and I've heard from a lot of lenders, like she clearly knows what she's doing. I mean, obviously to do 100 million plus in this year, you have to, but she's super sharp, super agile in conversation. So she's somebody that can really help get you deals, close deals. So we're going to have her on later, but.
Hey, John, if you don't mind, this is DeAndre. I'd like to chime in a little bit
go for it.
on, so on the point of interviewing the lender, I think that's a very good idea. Sometimes, resources that work for one person may not work for you. That's one good reason to interview them. And number two, also you get the opportunity to set the standard and let them know what you're looking for in a lender. And it's better to do that up front than to get into transactions and have the anxiety of, oh my goodness, are they going to perform to my standard? So that's my little bit of input from my experience.
Yeah, 100%. And that's great input. And setting the expectations is important because it makes it easier. If those expectations aren't being met, it makes it easier to push a little bit than if, it wasn't clear in the beginning. So
exactly.
I typically try to have buyers work with my preferred lenders that I have experience with, I have a relationship with, and I know will do the job. But if a buyer comes to you with a lender that, they have a relationship with, or their brother used them or whatever, like it's tough in this industry to get business. So I don't necessarily try to like pull people away from someone, but I will talk to a buyer's lender and, ask some of the basic questions about how they work, and you know, even just if you're not specifically interviewing them per se and asking targeted questions, you can get a feel for how professional somebody is, and how, you know, the level at which they'll operate in a conversation with them. So I'll talk to a buyer's lender, get a feel for them, but then also ask, you know, specific questions, and ask them like, okay, like when we're ready to write an offer, and I'll do this right when I get a buyer, like if they have a lender that they come with, I ask them if we're ready to write an offer, you know, what can we write? If we need to be aggressive, it's a multiple offer situation. What's the quickest close that you can write? What's the shortest loan and appraisal contingencies that you can write? And I also tell them, sometimes people will just tell you what you want to hear then, but I make it really clear, you know, going back to what DeAndre said about kind of setting the standard, I make it really clear, like, I want to be aggressive as possible, but I don't want you to put us in a situation where you're asking for more time. So if you need 10 days, then tell me 10 days, don't tell me 7, and then, you know, be coming up short on day 6. Then that way, if they said 7 days and you really, you know, question them and made sure that they're really comfortable with that, and you are a little nervous when it comes to day 5, day 6, you can remind them like, hey, we made it really clear that you could do this in 7 days, and, you know, unless something happened to where it was different than what everyone expected, like, they should be able to deliver on that. So setting that standard when you're having that conversation will make it easier to push when you do get down and dirty in the trenches of a transaction. So that's a great point, DeAndre, and kind of building that relationship and setting standards early on, because it makes it a lot easier when everybody has clear expectations of what they need to do to, you know, make a transaction smooth. So Patty will be on here in a couple minutes. We'll kind of get into the basics. I might as well just get into like the super basics before she jumps on, but super basic. What is a mortgage? So, I mean, it's obviously everyone knows what it is, but just to kind of talk about it in more specific terms, it's a loan that is secured by property or real estate is called a mortgage. In exchange for funds received by the home buyer to buy property or home, a lender gets the promise of that buyer to pay back the funds within a certain time frame for a certain cost. The mortgage is legally binding and secures the note, giving the lender the right to have legal claim against the borrower's home if the borrower defaults on the terms of the note. One day we'll get, you know, so you have an understanding of it. You know, we can talk about the foreclosure process and how that works. It's pretty drawn out here in California, but you know, the title and escrow geek in me had to put this part about, you know, the document that secures the lender's interest in the home is a deed of trust, which is recorded along with the deed granting the property to the seller's buyer. The deed of trust is released, which is called reconveyance, once the property is paid off and it's owned free and clear. So, you know, there'll be a deed, there'll be a grant deed where when someone buys a property where the seller gives that to the property, the seller gives that to the buyer, but along with the grant deed, unless it's a cash transaction, there will be a deed of trust that has all the specifics with the lender as the beneficiary, basically showing that if certain terms aren't met, then the lender can take control of the property, you know, through the foreclosure process. So just understanding kind of, you know, how it works on paper is, you know, important, but you know, it's not something you're going to explain really, but, you know, like I said, we're really kind of getting down to the basics. And then we're talking about what do mortgage payments include? So this is something that's important because, you know, when you're talking to buyers at a high level, you want to be able to explain this, and then they'll really go into detail when they get talking to a lender. So I'm speaking of lenders, Patty's jumping in. Hi, Patty, how's it going?
Hi, can you see me?
Yeah, I don't see your video. We have a screen share on right now. I'm seeing if you're in here. I see a cool butterfly on a beach maybe. But we'll give you speaker view in a little bit. I'm going to go through these slides. Thanks for that call yesterday. I had to jump early and I had a bad connection, but what I heard so far was awesome and pretty exciting. And thanks for, you know, your confidence and your commitment to the team.
Of course. I'm sorry that it says Parisa. My daughter uses this computer for school, so all the settings are screwed up.
I've had that too when I log into Zooms for sure.
Yeah. Okay. Hang on just a second. Let me just try to get
Cool. So I'm just going to kind of keep going while she gets situated. So she's just going to kind of cruise through this with us, and she can chime in with her experience and her perspective on, these basics that we're going through. So when you're talking about a mortgage payment, there's a couple different elements to it. But typically people talk about payments in terms of PITI. So the P is for principal, and that's the amount borrowed. So, hey, Patty, you good?
I'm good.
Okay, cool. So basically, we're just going to kind of go through the basics. These trainings are kind of geared towards newer agents, but we definitely have some experienced agents on here too. What I was thinking is I'm just going to kind of go through a lot of the basics and go through, some of the key things in a mortgage, and then go through different types of mortgage, and then run through the process. And then I'm going to defer to you, to each thing, or feel free to chime in if you think that, one, if I get anything wrong, definitely chime in, but also anything you can add that will just help deepen the understanding of this for agents will be.
Of course, yeah.
So I just explained, obviously, basically what a mortgage is, which everybody knows. But now we're talking about what the payments consist of. And when people are talking about payments, the importance of making sure that they understand it, what if it's PITI, if it's just the principal and interest. So I just started off with P, which is principal, and that's the amount that's going to go towards the total amount borrowed. So on a $500,000 loan, $500,000 is the principal. Over the life of the, say a 30-year fixed loan, they're going to pay a lot more than $500,000, but the $500,000 that they're paying down is the principal loan amount. And then the I is interest. So that's what the lender is charging to borrow the money. So on a mortgage, then they're amortized, which means they're it's regular fixed month payments on a schedule, and they split up the interest over the life of the loan, and then they're paying that down. So when they pay a mortgage payment, some of it goes towards principal, some of it goes towards interest. In the first half or so of the loan, I think a lot more of it goes towards interest than principal. So if people are ever asking you, and usually people understand this, but if they're saying like, hey, I made $2,000 mortgage payment, but my principal balance only went down $400 or $200, it's because they're paying a lot more interest in the beginning than they are principal. Taxes is the T in PITI. So they take that into account because when you purchase property, you're going to be paying, local taxes. And even though those are paid annually, they take that tax obligation, divide it up by 12 months and put that towards the monthly payment. And they do the same thing with insurance. So, you have an insurance policy to protect the home. This is going to be required when you have a lender. I mean, anyone should have it. In case your house burns down, especially here in California, but they'll take the insurance amount and they'll divide that into 12, and then they'll add that to, with a PITI payment also. So those are on a normal mortgage payment. That's typically what people are going to be talking about. So sometimes people might think that their payment's going to be way lower than, they did some online calculator and they thought their payment was going to be, a few $100 lower than what when they're getting more information. If it doesn't include taxes and insurance, that's typically why. So understanding what PITI is important as an agent, because it's important that your buyers understand, when they're talking about mortgage payments, that they're talking about all of the things that go into it. Anything on explaining PITI, Patty?
Yeah, so taxes and insurance don't always have to be included. It depends on their down payment structure and the loan type. So when generally people like their payment, they want to know what all their costs are associated with the house. So in general, you're always talking in terms of PITI. Some people will ask you if you have to keep it included in the payment or not. And the answer is no, you don't have to, not under every circumstance. Homeowners insurance is paid once a year. Taxes are paid twice a year. I'm sure you guys know that. So when they set up an impound account so that their payment is PITI, what happens is they the bank establishes a small escrow account for them and pays the insurance once a year and pays the taxes twice a year. So that's what happens. So when they think their loan is has a fixed rate, the principal, the PI part doesn't ever change, but the TI part can change. So the taxes and insurance can change. The principal and interest payment will never change. Those are kind of things that do come up from time to time in a conversation.
Perfect. Yeah, and we'll get to impound accounts and like closing costs on here too. But
Okay.
it's important to understand that it's not always PITI, because not every loan is going to require them to pay that. Some of them are, but when they're talking about, so now kind of moving on to qualifying for a mortgage, when they're and Patty, I'm going to have you explain this because it'll make more sense coming from you. But one of the key factors in how much a buyer can afford and what types of loan products that they can get will be their debt to income ratio. So basically it's, all their monthly debt obligations divided by their gross monthly income. You'll see an example here, but this is one of the key components when they're going through the application process and figuring out what they can afford. The debt to income ratio is one of the main things that are going to affect that. So Patty, you want to explain DTI and how that works?
Yeah, absolutely. So a lot of times when you ask someone, when you're taking a loan application and you ask someone, how much do you make? They'll ask you gross or net. And you always calculate the debt to income ratio based off of the gross income. This is something, of course, we do for you. You don't have to worry about it, but it's good to know when the conversation comes up. So the maximum debt to income ratio on an FHA loan is 57%. So 57% of the gross income can be encumbered by the mortgage payment, the full PITI. When you're qualifying for a mortgage, even if you don't want taxes and insurance included, you have to qualify with taxes, insurance, HOA, flood insurance, everything that could possibly come up. So it's the gross income. On an FHA loan, the maximum is 57%. Same with VA loans. Those government loans will go really high on the debt ratio requirements, and that's mainly because their mortgage insurance costs so much more. On a conventional loan, you can go just over 50% with Freddie Mac and at 50% with Fannie Mae, debt to income ratio. Standard conventional. Jumbo financing, you're limited to 43%. 43% is the maximum debt to income ratio. And then in some cases, depending on how well priced an investor is, the number is even lower than that. So the higher the loan amount, the more restrictive it would be on the debt to income ratio, and it's calculated based off of the gross income.
Awesome. Yeah, that's perfect. And that really shows how a person's debt to income can, somebody with a really low debt to income ratio has a lot of options in the loans that they could potentially qualify for, so they can really look for what's going to be the best and the easiest and the most competitive. Somebody with a really high debt to income, might be limited to, a VA, an FHA loan. And when we get into loan types, you'll see that's why these loans exist, is because they want to provide opportunities to, various borrowers depending on the qualifications. But that DTI is the key thing. And so keeping obligations low, not buying a new car, not having a bunch of credit card debt, is gonna keep that debt down. And then obviously increasing your income is gonna make that ratio even higher. So when you're talking to someone who's, maybe a ways out and is just strategizing them, keeping their debts as low as possible is gonna help them qualify, because it's gonna mean they're gonna be able to, one, have more options, but then also qualify for a higher loan payment because they take in that PITI into account. I'm going to back up one slide here real quick. And Patty was talking about how all of the things that could potentially be part of their payment are calculated as part of the debt when they're calculating DTI. And so on some loans, if they have a lower down payment, there's private mortgage insurance. Sometimes that's paid monthly, sometimes it's paid all up front. But if it's paid monthly, or if it, however it affects the payment, that goes towards the DTI. And then if there's a HOA, it's not part of the mortgage payment, but if the property they're buying, if buying this property means they're gonna have a $400 monthly payment, they're also going to include that $400 monthly payment when they're calculating their DTI. And that's why when somebody is shopping for single family homes and then switches to condos or townhouses, you really got to make sure you talk to the lender, because that unless they have a ton of room in their qualification, what somebody can qualify for on a single family home and what someone's going to qualify for on a property with HOA, the HOA property is going to be lower, because when you add in the HOA fees to the DTI calculation, it's going to raise their payment and lower what they can qualify for. Right, Patty?
Absolutely. That's a great way to put it.
Awesome. And so, I put it here in red, like, one, I put here, make sure, this is just generally speaking, make sure your buyer is aware of their options and discusses various scenarios with their lenders, because you're not an expert on the different types of loan products out there available and what they're going to qualify for. But what you can tell your buyers is that depending on the situation, they may or may not have options. So obviously, like we were talking about at the beginning, they're hopefully working with a lender that you're confident, you have a relationship with. If they're working with a good lender, then any good lender is going to really make sure that the buyer knows all their options and is going to essentially recommend what's best for their specific situation when they take into account everything the buyer wants and needs in their overall situation. But if you're just having a casual conversation with someone that's shopping around online and doing calculators and stuff, like, make it clear to them that like there's different ways to do the financing, and that they want to make sure they understand all their options. So it's as being a part of being a resource is just making sure people know what's available to them. And then
and PMI is mandatory for the life of the loan with FHA financing. So when they have a conventional loan, it's called PMI because it's private mortgage insurance, right? And so the private mortgage insurance is applicable to conventional loans. On a conventional loan, they can remove it without refinancing. On an FHA loan, you can't do that. On the FHA loan, it's required to remain for the life of the loan. So it would require a refinance out of FHA into conventional to get rid of it.
Yeah, and that's where, like, obviously the lender knows a lot more about how all of this works. So if somebody's right on the cusp of being able to do a couple different types of loans, one might make more sense, in the immediate short term. But if they're really close from switching from one loan product to another, and in the long run, it's going to be better for them, that's where the lender is really going to be able to be a resource and find the best fit. Just like, we consult with buyers on what they want and need, and we use our expertise to guide them towards the right home based on what they want and need. A lender is going to do the same thing with their financial situation. So that's where, deferring to the expert on picking the best loan, like, that's not something you're going to be doing. You want to know what an FHA loan is, and you want to know what a conventional loan is, and all the different options, but you're not going to be the person, recommending one or the other. You're going to be the person recommending them talk to someone that's going to look at their whole picture and then help them figure out what's best for them. Like, really, one thing I'm trying to get all the new agents to understand, Patty, is like the importance of having a general understanding of things so you can talk to people about it and understand their questions, but also knowing when to just defer to an expert and connect the buyer with, whether it's a tax person or a lender or whatever.
Yeah.
Being able to just connect, just refer them along, because it's, if you start talking to them about financing and can answer the basic questions and then connect them to a rock star expert like Patty, and she breaks it down for them. I mean, referring to awesome people that do a great job and really wow the client with their knowledge, that makes you look good too. So rather than trying to go out over your skis and talk about mortgages in more detail than you need to, just know when to transfer that person over to the expert so they can really, bring it home. And one more thing on DTI and qualification is, typically your lender will tell you like where they're at. They're approved for this, and maybe they have a little room, or this is what they're comfortable with, but they could go higher. Just let me know. Or they might tell you like, okay, we're squeezing everything as tight as possible, and this is their max. So when you are in situations where things change a little bit, and say you're going from, obviously a single family to a townhouse, but say you started looking in Walnut Creek, and then now they want to look in Oakland. Like Oakland's going to have a higher city transfer tax and higher property taxes.
Yep.
And if somebody's at the max of their purchase price and the DTI is maxed out based on buying a home in Walnut Creek, their qualification can change if now you're looking at Oakland, because they're going to need more cash to close because their city transfer tax, their property tax is going to be slightly higher, which is going to make their monthly payment higher. And if they're at that limit, you might end up, putting them in a contract at a price that they can't qualify for. So it's super important that with those people that are really pushing the limits of their qualification, that, when you do write offers, you're checking with the lender, to make sure that the numbers work out.
Yep.
And Patty, I was just talking about earlier, the importance of having a good relationship with the lender and being able to communicate and ask questions and just be really confident that you're working together. And so like, especially for newer agents that might not know the difference, really working with someone awesome is just makes your life so much easier and makes you better at what you do. So.
Yeah, at the pre-approval stage, you should always know the limitations of your client. So I'll do things like, I'll say this client is approved for 750,000, strictly single family residence, no HOAs can be added. And I'll highlight that in the email, because we all know that everyone gets pre-approved and then they get really excited to shop over their budget. So we gotta tame that.
Yeah, totally. And it's good to know at that pre-approval stage, where the client stands, because when the lender tells you like, okay, this is it, this is pretty much it, and you see your buyers starting to kind of, get attracted to higher price points, you can kind of put the brakes on. Or if the lender knows, yeah, this is what they're comfortable with, but they could go way over if they wanted, but they told me, this is what they're comfortable with. You can have that in your back pocket. So, okay, you're looking at price houses that are 800,000, you got a couple times and nothing in that price range is really doing it for them. Then you can be more comfortable because the lenders told you they have some room if you wanted. You can be more comfortable exploring like, hey, let's just go look at some $1 million homes to see if it's really worth the difference for you. And then if it's something that you think might be better for you in the long run, you can talk to Patty about what that payment will look like and see if, it's worth kind of making a jump up in price range. So you really work together and kind of strategize on figuring out what works best for, each buyer's situation. All right, so we talked about impound accounts. Those can be confusing, so I want to really make sure that and we kind of breeze through it. Sometimes people refer to them as escrow accounts, which can be confusing because it's different than title and escrow that handles the transaction. So and they're not always required. And when we go into loan types, we can kind of talk about when they're always required and when they're not. But does everyone on here understand what an impound account is? If a lender is requiring an impound account, what does that mean to the buyer and their monthly payment, and how does it work? Everyone good on that? You totally, because it's confusing. So don't be scared to ask for some additional clarification.
Yeah, could we actually just go over that really quick?
Awesome. Yeah, Patty, you want to just explain impound accounts one more time?
Of course. So an impound account is referred to as a escrow account or an impound account. It's basically when the client decides that they want to have taxes and insurance included in their monthly payment. So when they decide that they want to have it included, what they're essentially saying is that we want to establish like a mini checking account that's managed by the loan servicer. So if Bank of America is sending me my monthly mortgage statement, on each statement, I'm going to see principal, interest, escrows, escrow balance. I'm going to see how much money, a portion of my payment goes into that account every single month, so that when taxes are due in April and November, my account will have enough money in it so that the servicer can cut the check to the county and once a year to my insurance provider. So an impound account is an account that's managed by the loan servicer, that's established at closing, that's used to pay the property taxes and the homeowner's insurance for the client. When people ask, a very common question is, what are the pros and cons? What's the benefit of me doing this? My answer is always, it's strictly a matter of convenience. If you set up an impound account, you're essentially taking the money out of your checking account where it earns interest at a very, very, very minor amount. And you're taking that money and you're putting it in the hands of the loan servicer on a separate account, and they're managing that bill for you. That's the only difference. So in simplest terms, the benefit of having an impound account is convenience.
Perfect. Yeah. And why it's required sometimes versus why it's not is, somebody that's really financially strong getting hit with, an insurance bill and two, sizable tax bills a year is no problem. And they're financially savvy. On some of the loans where people are really just putting it all together to make it happen, and this is their, a big financial move to them to buy a home. If without that impound account, they might put themselves in a position, where that tax bill comes due and they don't have the money to pay it, or that insurance policy is due and they don't have the money to pay it. So it's definitely super convenient, and it just kind of forces people to manage their money better now that they're committed to mortgage payment, because even though something's only due, once a year or twice a year, they're saving for it because it is part of their monthly expense, because it's part of the expense of having that mortgage. So it's convenient, and it's kind of like a financial management tool for some people that having those big lump sums due not monthly, it might be tougher to manage. So
Right.
Thank you for that explanation. Harrison, does that make sense?
Yeah, that was really helpful.
If you had to explain it to somebody tomorrow, you feel confident you could explain what an impound account is?
Yeah.
Cool.
That's one thing that really and it's confusing to buyers too. So it's like, I'll still get questions from people that are on their home for like 6 months. They're like, wait, like, what's this escrow account? Like, don't I have to pay my property tax bill when it comes? And they have an impound account. So it's one thing that it can be tricky. So, just really making sure it's clear is important. All right, so let's talk about closing costs, because that's something that will come up when you're talking to potential buyers also, because people know they need to save up for down payment, but then they also need to make sure that they save up for closing costs, because that's going to be, having the assets to cover that is going to be part of their qualification and how much they can afford. And also they just need to be able to wrap their head around it, because sometimes if they're trying to make the decision of buying a home or not, the amount of cash that it's going to take up front is a factor in that. So understanding that the closing costs are, it's super important, because you're going to need to explain, roughly what it is. When it comes to just, sometimes people want to know, like, what's the closing cost on this? What's the closing cost on this? Like anything else where you're putting numbers on it, you want to try to just give people a range, because you don't want to commit to a certain number and then be wrong either way. So, I typically tell people that there's different factors, and it'll depend on the property, how much your closing costs are. But, I usually say it's between 2 to 3% of the purchase price. And then I'd rather people prepare for a higher amount and then be pleasantly surprised that it's lower. If you're just putting a ballpark number on it, Patty, are we safe saying 2 to 3%?
3% is perfect.
Okay, good. So that's what I've been saying for years.
The breakdown of that is really simple. The higher the price, the lower the percentage. On a $1.8 million deal, it's not going to be 3%. It's closer to 2%. So when a client asks me that in the pre-approval stage, my answer is you always need to adjust. You always need to, not adjust. You always need to allocate or budget for 2 to 3% of the sales price for closing costs. And they'll say, yeah, well, I was talking to Chase and they were like, my closing costs will be $3,000. And I say, when you're talking to a bank and you're dealing with them, they're not giving you the full picture, because what they're not including in that figure is prepaid items. So I don't want to get too far into it, but why it's 2 to 3% isn't strictly closing costs. And if you're working with me, 9 out of 10 times, you're not going to have lender fees. And even if you did, they're around $1,200. They're minor. So the title and escrow fees, those add up. But most importantly, it's those transfer taxes, and then it's the amount of reserves that they have to put up for the initial funding of that impound account. That in itself is oftentimes, depending on the time of year, more than what the closing cost sum total is. So if you're able to answer that question by saying budget 2% of your sales price, 2 to 3% of your sales price for closing costs, and in addition to budgeting that, just remember that the closing cost number consists of everything above and beyond the down payment, property taxes, homeowner's insurance, your notary fee, your escrow fees, your title fees, your lender fees, your appraisal fees, your inspection fees. So that's what it breaks down to. So depending on where they're getting that information, you will they will so appreciate that you've pointed out to them every, the different aspects of it, as opposed to just saying, because they're going to hear, well, this person said this and this person said that. No. Some people often leave these tidbits out. And I want you to have a thorough understanding of what you're getting yourself into, because our policy is no surprises, ma'am or sir. We don't want you to have any surprises at that closing table. So let me explain to you, above and beyond your budget for the down payment, these are the factors. And when someone talks to me, that initial call, I'll say to them, there are two main questions I ask. What is the maximum amount you want to spend per month? And what's the maximum amount you want to spend out of pocket? 9 out of 10 times the number of out of pocket they give me, they've only considered for the down payment. They're not even thinking about closing costs. So it will really go a long way when you make that distinction for them.
Yeah, and I love that, and thank you for breaking that down, because that whole scenario is a perfect example of why we do training like this and have you understand things at a wider level. So when somebody tells you, you might know to say like, okay, yeah, you might have heard, you can say when someone asks about closing costs, say 2 to 3%. But then if somebody tells you like, oh, well, I just talked to Chase and they said my closing cost would be $3,000. If you don't understand the breakdown and how it all works, you're going to be sitting there like, well, I don't know. Like you're in a spot where you can't be an expert because you don't understand enough about the topic to really break it down. So knowing enough about something to be able to understand people's questions and understand what they're saying is super important. And then at that point, you can connect them to someone that's really going to break it down properly and not just, not that it's a bait and switch, but sometimes people will leave information out to make things look more attractive when really like it's not a true picture of how it's going to work. So talking about the different types of closing costs, basically just kind of going through what everything Patty just said is there's the cost of the loan. So it'll be different with every lender. And that's, one thing to make sure that you understand. And that's the costs associated with getting a loan. So it's, the lender fees, the underwriting fees, the appraisal, things that the lender's going to charge. So when you're trying to figure out what lender to work with, it's important that you know that, because if you don't know the options you're recommending people and you recommend someone that's going to be, charging thousands of dollars a close and they don't realize until they're far along the process and they talk to their friends and they're like, no, my lender didn't charge any fees, or, I just paid for, the appraisal or whatever, you are now in a tough spot because your recommendation cost them more money. So understanding the difference in costs associated with lender. And it's fairly competitive overall, but it's you want to work with someone that's going to be, as competitive as possible, because you want to get your clients great deals. So Patty can, talk about that a little bit more, but like she said, so when your costs typically for a highly qualified borrower, what are the main costs?
So right now, if I'm dealing with a client who in your marketplace's average sales price is $1 million, 1.2, and they're putting 20% down, they're not going to have any lender fees. Their interest rate is going to be 2.75%. They will pay for an appraisal that'll run them anywhere between $600 and $850. You have a home inspection, which will run them probably $650 to $750 as well. In most of your cases, if they accept the disclosures, then, in some cases, they don't even buy their own home inspection because the seller's already done that, right? So that's also case by case. So when it comes to the lender fees, one of the most important things to distinguish is you have your big banks. A lot of people like to work with the big banks because it gives them a sense of security. Agents don't like the big banks because they take too long to process things. There's too many layers of management, and there's not enough underwriting protocols that happen in the beginning of the transaction. So there's more chance, there's a higher probability for an error throughout the process. So what happens in that case is then you have banks like us. Guaranteed Rate is one of the top 10 mortgage banks in the country. We only focus on mortgages. And then you have brokers who take your client's package and they have no control over the process. They have to ship it to the lender, and they're completely removed from that process. In all of those cases, the fee structures are different. So on a jumbo loan, 9 out of 10 times, there's no lender fees. And it really depends on how aggressive they want to get with the rate. They always have the option to buy down the interest rate. So then on standard financing, you have your average lender fees should be around $1,290 plus an appraisal fee, plus your inspections. Then you have your title and escrow fees. You can Google a quick little thing to show you this anytime. So you Google Chicago Title Fee Estimator, and you can throw in the county, the sales price, and so on, and it'll spit you out within 2 minutes an estimated closing cost statement. Now, those closing cost statements are something that I use all the time to put together a loan summary for the client who's shopping. Some people don't care. They just need to know a round number. Some people, they want to see it. So we can create a loan summary that breaks it down, but it's simple. It's lender, title, escrow, city, county. That's it.
Yeah.
Lender, title, escrow, city, county. You have city and county transfer taxes, city and county recording fees. You have your lender who encompasses the underwriting and the processing and the appraisal. And then the title company, which covers title, escrow, lender's policies, owner's policies, and also any courier fees and notary fees. So you can summarize it as lender, title, city, county.
Perfect. Yeah, and that what she's talking about with the Chicago title calculator, we had our Chicago title rep on here recently. Like, everybody should have a title company, whether it's Chicago, Fidelity, whoever. Everybody should have an app like that on their phone, so you can, when people do want to see a more detailed breakdown, you can do it, because the title and escrow fees are just based on the purchase price and loan amount. So those will never really change. They can't change them. They have to file them with the Department of Insurance. And then, if you're typically working with the same lenders, you can actually plug in the lender's fees into that app too. So when you are generating those estimates, it's pretty accurate to what the lender's closing costs are going to be. So beyond those, the other things are that when you're prepaying, that are the recurring closing costs, which are the property taxes and the insurance, which are paid to close. And like Patty was saying, depending on the time of year, those can really beef up the closing costs, because if they need to collect 8 months of taxes in advance, that could be pretty significant. I mean, I had a client recently, it's like an $800,000 purchase, and because of where it was in the tax year, they needed to collect almost 9 months of taxes, and that over probably doubled the closing costs. So if they didn't have to have that impound account and they didn't have to collect that, they wouldn't have had to pay that at close. So that's just one thing to understand, is that when people are doing impound accounts, they could potentially collect a bunch of money for taxes up front. It's money they're going to have to pay anyway, because that tax bill is going to come due. They're just going to have to put it in the escrow account up front to make sure there's funds in there when that bill is due, because there's not going to be enough monthly payments between the close and that tax bill coming due to cover that next payment. So any questions about closing costs, how they break down, how to explain it to a buyer? Everyone pretty comfortable with that? Definitely don't hesitate to ask questions. And there's other people on here with those same questions, and you'd rather bring it up now than it comes up from a buyer. Everyone good? Get some mortgage experts on here. That's good. Harrison?
Yeah, can you elaborate a little bit more on that tax collection that you were just talking about?
Yeah, sure. So taxes are due, the bill for the property taxes comes out in March and it's due in April, and then in November and it's due in December. So if you're closing escrow today, December 1st, your first payment doesn't start until February 1st. And then your taxes are due again in March. So if we're breaking down the tax bill, let's say that the tax bill was $1,200 a year. That means every month the tax bill cost $100. Now, what we're going to do is again, going back, it's confusing. So I want to go repeat myself. Your closing escrow today, your annual tax bill is $1,200 and your first payment is not due until February 1st. And your tax bill is due the exact next month. So if you're closing today, sorry, if you're closing today, then what I need to make sure of is that by March, I have $600 in your account, but I'm only collecting one payment before March. So that means from the payments that you make, I'm only going to have 100, but I needed 600. So at closing on December 3rd, I would have had to collect that extra $500 from you. So if you take that 12,000 and you make it 20,000, you can see how it quickly adds up. So again, your closing escrow on December 3rd. Your first payment is not due until February 1st. Your tax bill is due March. In March, that escrow account needs $600 in it, but you've only made one payment. So I only have 100. So at closing, I would have had to collect the deficit. That extra money comes from you at closing. So the closer to the due date of a tax bill that you close, the more money is collected for the impound accounts. Now, the tricky part of this, another tricky thing is, and you guys maybe can examine a couple closing statements to figure this out, but there's prorations made. So if the tax bill is due at closing or close to closing, but a portion of that needs to be covered by the seller for the time frame that they owned the property, the title company is going to make an adjustment for that and give the buyer a credit. So the best way to think about it is it's due twice a year. And whenever their payments start, there has to be enough money by the time the bill is due to cover at least 6 months worth of that tax payment. So they pre-fund the escrow account. In addition to pre-funding the escrow account, what adds to the closing costs is if you're closing escrow closer to the due date of a tax bill, the buyer pays a small portion and the seller pays for the portion for the time that they owned the property. That's a proration that would exist on the tax on the closing statement. So you're going to have to examine a few deals that closed in December. Look at the closing statements because that's when taxes are due. November and December, look at about 5 closing statements from your transactions on your team in November and look at what it says. It'll show prorations for taxes credited to the buyer, because it's really the seller's bill that's due, right? But he's selling the house. So for a portion of that bill he owes and a portion of the bill now the new owner takes, and it's based on the date of the closing. But to summarize the impound account portion, the tax bill is due twice a year. So you're pre-funding your escrow account to make sure that when the bill is due, depending on how many payments are made, there's enough money on there to pay the bill.
Awesome. Yeah. And I mean, you know, I've been doing this for a while. I worked in title and escrow. Taxes are confusing. The prorations are confusing. It's made even more confusing by the fact that the tax year is different than the regular year, you know,
Yes.
than a calendar year. So it's not like, okay, June is the middle of the year. So, you know, again, you need to understand this. So when those questions come up, you understand why the closing cost is higher and why they're getting taxes. But if they need, you know, a detailed explanation of it, you obviously want to know what it is, but you also want to just defer them to a lender or to the title person that can explain it to them, because it's tricky to explain. So I never try to explain it in detail. I explain to them, you know, what it is, but if they want a full-on breakdown, I defer to a lender or title, because they're just going to be better at explaining it. But you need to know, again, you need to know why it is how it is. I think that pretty much covers it on closing costs, just as far as what they are. Yeah. Any other questions about closing costs real quick? Cool.
I have a quick question. This is probably going to be a dumb question, but
No dumb questions.
does it make a difference whether they do an impound account or not an impound account based on like their loan amount or buying power, if that makes sense? Like,
Yeah, no, that's a really good question. It absolutely makes a difference. So when someone's putting 3% down on a conventional loan, they don't have the option of waiving escrows. If they're putting 5% down, the system may or may not approve them to waive the escrows based on the risk factors assessed on the approval. If they're putting 20% down, no question, they have the option. 10, 15, 20% down. So the higher the down payment, it's absolutely an option. The lower down payment, there is not an option. With government finance loans like FHA or VA, they do not have the option of removing the impounds. It has to be included.
Okay, perfect. Thank you so much.
Of course.
And yeah, basically the stronger the borrower, the more like financially qualified and savvy they're going to be. So the more confidence that the lender's going to have that they're going to be able to manage paying those, you know, the lump sum bills that come up once a year or twice a year with the taxes. So cool. Thank you very much on that. All right, so we're going to go through, we have a little bit of time left to just go through the different types of loans real quick. Patty's kind of hit on the differences between some of them here and there. So we'll kind of go through this fast and then just to do a quick overview of the process. Patty, are you okay on time? We go until noon, but I know you're super busy. I want to make sure you're good.
I'm good. I'm all yours.
Okay, cool. So we're just going to go through loans. And then, you know, we'll leave a few minutes just for questions because I think it's really valuable if you have specific questions to while we have Patty's time to get those answers now. And really, like, don't hesitate to reach out to Patty or you know, if you have lenders you work with, if you have questions, because you'd rather get clarification up front than you know, be stuck in a situation where a client's now asking a question and you don't have the answer. So really, like, knowledge is power. That sounds, but the you know, the sharper your training is and stuff like this, the sharper you're gonna seem when you're in front of clients. So cool. So different types of loans. You're gonna hear conforming and conventional. Conforming basically means that, so there's Fannie and Freddie, who are government organizations that basically have created a secondary market for mortgages. So they're organizations that basically buy mortgages, but for them to buy, for Fannie and Freddie, who are the, you know, the largest secondary market of mortgages, those loans have to meet a certain set of guidelines when it comes to, you know, the buyer's qualifications and all of that for them to purchase that loan. So that's going to be a big bulk of loans, because that's where these lenders and these brokers, it's not that they have an unlimited amount of money to loan. They have money, they loan out that money, they hang on to it for a little bit, and then they package them up and they sell them, you know, typically to someone like Fannie or Freddie or big investors. So a conforming loan needs to conform to those standards to be sold. So when we talk about conforming loans, then they follow these guidelines. These loan limits are wrong. They just went up. Part of what, in addition to the guidelines of qualification to conform to the standards, they have to be under, you know, regional loan limits, and these just went up. So in the like the Bay Area where things are more expensive, it's up to like 822 now.
822, 300 something, yeah.
Yeah, 822 and some change, which, you know, it's great. Like it like, if your buyer maybe doesn't qualify for jumbo, and they're right there on the cusp, like now they can get a conforming loan, and the financing, you know, might be a little easier with those higher loan limits.
And why that matters is because a jumbo loan requires reserves. And a lot of people might have enough money to buy, but they don't have money left over after down payment and closing costs. For a jumbo loan, you need 6 to 24 months of reserves. Reserves refers to the amount of money left in your bank accounts after you've paid for the down payment and closing costs. If it's a 401k, you don't get to use 100% of it. The biggest reason people cannot qualify for jumbo financing is lack of reserves. It's not always credit, and it's not always, you know, a lot of things. So why this factor is important, I just really want to highlight that. So going up to 822,000 is going to help 25% more buyers qualify for those price ranges than they were before. It's really a big deal for us in the Bay Area. Yeah,
especially in the Bay Area, because it's that extra whatever $60,000, you know, when you look at it in terms of the percentage of the loan to value, that can bump somebody that couldn't get jumbo into kind of the next tier of price range of homes with it, and up their purchase amount because they couldn't get jumbo. So did my explanation of conforming loans make sense? Like basically they're just meeting certain guidelines, so they're
Conforming really refers to the loan amount. So conforming loan amount has also gone up. So as of before this change, it was 510,400. It went up to 510,400. Now it's in the $548,000 range. The conforming loan limit is that's what that means. Anything above that, up from the 548, 500 to the 822, 300 range is considered high balance. So it's a little bit riskier and it has a little bit more cost associated with depending on the credit score. So the word conforming actually strictly is relative to the loan amount. And that's the smaller limit, the general limit. So above that is what's considered high balance.
Got it. And then above that threshold is considered jumbo.
Yeah, technically anything above the conforming limit is considered jumbo. But if they don't qualify for those jumbo programs, that's where Fannie Mae and Freddie Mac created that high balance space. That high balance space gives them the option of getting the loan at a higher cost without meeting all those other qualifications.
Okay. And in a fairly normal market, the difference between a conforming and going high balance, the hit that they might take on interest rate and everything is not too bad.
Depending on the credit score, they've, as a result of COVID, so COVID created a lot of mitigating factors and guidelines, risk mitigating factors. What does that mean? That means that the lower your credit score is, the more likely you are to have a challenge paying your bills on time, statistically speaking. So the higher your credit score, the less of a difference it's going to make in your cost depending on high balance or conforming. The lower the credit score, the more of an impact it'd have. So if the credit scores are, let's say, under 680 and they're getting a high balance loan as opposed to a conforming loan, the difference in cost could be 1% of the loan amount. That's a big difference. And it really just depends on that credit score. So those are huge factors in conventional financing that really make a difference in the cost. But the thing is that it might be too early to talk about an appraisal waiver, but when you're dealing with an approval with Fannie Mae or Freddie Mac, they have an automated underwriting system. So sometimes your seller will say, I want proof of funds and DU approval. DU approval refers to Fannie Mae's desktop underwriting. LP is the same thing, but it's for Freddie Mac. It's called Loan Prospector. So these are online systems created by Fannie Mae and Freddie Mac. When we input the data, it analyzes the risk. So if someone has a lower credit score and they don't have any reserves and their credit score doesn't meet the threshold, instead of allowing a 50.5 debt ratio, the system might say, sorry, we can't approve you. And I can't approve it unless I lower the debt ratio or add to the reserves. So all of those risk factors affect the pricing. So it's really not black and white to say, okay, well, if someone's going from this conforming to this high balance, there's always going to be a difference of 0.5%. It takes all of those factors into consideration.
Awesome. Yeah. So, and we're just seeing a theme here where their income and their credit score and their assets are going to change, what they can qualify for and the more options that are available to them. So when you're, advising people in the process, basically the stronger of a borrower that they are on paper, the more options that they might have, which will make their ultimate purchasing power and what their payment's going to be even better. So, obviously you want to advise people to make decisions that are going to make them more qualified borrowers. So, and then I think we basically hit jumbo loans. Jumbo loans basically are just, above that loan limit. Main thing with jumbo loans is you have to be pretty financially strong to qualify. Reserves are a big part of that. Obviously high credit scores, but if for really qualified borrowers that qualify for good jumbo financing, because typically, and I know for COVID's kind of made it a little wacky, but typically some of the better, for that really qualified borrower with tons of reserves and great credit, they can get sometimes lower interest rates on a jumbo loan than a conventional loan, right?
Absolutely. Jumbo loans are spectacular with pricing right now. So are conventional, but jumbo loans, anytime I have a client in the high balance range that has sufficient reserves and has a decent profile, I will try to get them approved based on jumbo financing guidelines instead.
Yeah. And I mean, this is a good time while we're talking about jumbo, just real quick, is like, obviously everyone wants to work at a higher price point and work towards that. Obviously, a higher price is everyone's going to make more money. But from a financing standpoint, and I'm just speaking generally, and this isn't always the case. But when you are working with people that can qualify for jumbo financing and have really strong financial pictures, it makes the lending part and the whole process just so much smoother on your end. So not only are you working with at a higher price point where you're going to make more money, it's also the potential for issues to pop up because their financing is just lower because they're just stronger. They have more options. They're working with high quality lenders because they have a lot of options. So not that you need another reason to be motivated to be confident and comfortable going after a higher price point, but last couple of years when my price point was higher, like my average price last year was like just a hair under $1 million. Working with these buyers and their financing is like it was awesome. So jumbo financing, jumbo bars is not anything to be scared of. So getting low on time here. So why don't we talk about FHA and VA, because that's obviously something that is super important to understand why, and maybe let's focus on FHA but those government loans in general. What do you have to say about those?
I think these key points are really important here. I want to give you guys a tool that most people do not know exists. Anytime you're dealing with a condo with FHA, don't trust the notes in the MLS. And anytime you're doing that, you can Google something, just Google this phrase, HUD approved condos, HUD, HUD approved condos. The actual HUD website, it starts with ENTP. When you look in there, there's a very general input screen. So you'll just want to put the state, and then for the drop down menu, click on approved. So it'll only show you the approved condos in your state, or you can obviously filter by city. Usually use the zip code where the subject property is in. It'll tell you whether or not it's approved. I can do it for you in an instant. Anytime, you could just shoot me a text, or you just do it yourself, because most I've been doing this for 18 years, and agents don't use this tool. They don't know about it. So again, you're Googling HUD approved condos. The website for the actual HUD system starts with an ENTP. You can put the criteria in there to see whether or not the condo is approved. So that's something that's cool that you guys can work on. All the other points on here are absolutely correct. The upfront mortgage insurance is almost always financed into it. And this is something that I would really like for you guys to pay attention to, okay? Because I'm looking at, there's a lot of chatter in the world about, ethics and what we do and how we are in control of the barriers to home ownership. And HUD and FHA loans have created a magnificent opportunity for people to get their foot in the door. But their mortgage insurance is almost double monthly what it would be with a conventional loan. And the mortgage insurance premium makes it so that if you're using FHA over conventional financing, on average, you're spending $13,000 more a month for the transaction than you would otherwise. So you're putting 3.5% down, but you have a 1.75% fee that's added to your principal balance of your loan. It's like an advance on the equity. So this is something that when you're sitting down with a buyer consultation for a first-time home buyer, and you're asking them if they have gift money or if they have a 401k and whatever your questions are, if you highlight the differences between FHA financing and make them understand that it's cheaper to go with conventional financing and saves them tens of thousands of dollars, you are winning. It is such a big, big piece to educate people on. And even if they can't qualify for the conventional loan at that time, you told them information that they otherwise wouldn't know, that they don't have to wake up 5-6 years down the line in the house and say, man, I wish somebody would have taught me that, because I could have either waited 30 days or asked grandpa to advance me the down payment or whatever the deal is. So I just want to really point that out. I have lots of conversations. I teach workshops in Oakland. I do online things all the time. And when I highlight that difference for someone, that really distinguishes me amongst my peers in that way. So I really want to share that with you guys. It's important for you to know that.
Yeah, that's huge. And making distinctions like that and opening up opportunities and different options for buyers that completely change how they're looking at things. Those are the things that really we were always looking for opportunities to really just lock in that relationship for life, and explaining things to them that will make them explore options that will completely change what's available to them or what it's going to cost. Those are the things that really establish you as an expert and as a trusted partner, and really, that's what gets you referrals. That's what gets you good reviews. Just the more, and you have to have the knowledge for stuff like that to be able to do it. So thank you for really pushing that, because it's for a number of reasons, it's super important that
Yes, it is.
New and experienced agents understand that FHA isn't always the best route and isn't always the cheapest, and if they're close to qualifying for a conventional, they can do it with a smaller down payment, and overall it's going to end up saving them a lot of money. So
Absolutely.
you've been doing this for 18 years. It's probably been a pretty wild ride. You've kind of seen it all.
Yeah, I have. I remember that when I started, I used to do every single thing myself, from the notary piece, you would even go do the notaries on jobs. I mean, everyone you met with in person. And, with the title company used to give you a farm pack that was about the size of an encyclopedia. And you would take that and you would cold call people one at a time for loans. So yeah, I've done every aspect of this business except for the real estate side. I've never done that. I've stuck to lending, but every aspect of it. So yeah, I've seen it all.
It must have been crazy doing mortgages when you were 13.
I know, right?
All right. And then VA loans, real quick. You think you had some great points on VA loans yesterday. There's a lot of misconceptions out there. So, 1 minute on VA loans.
You guys are the next generation of superstars in Oakland. You guys have the power to change how VA loans are viewed. Most agents will sit there and appreciate veterans on their Instagram feeds on every holiday that's associated with them, Memorial Day and Veterans Day, but no one wants to accept an offer from a VA buyer. Why is that? Because there's a misconception, just like with FHA, that there's going to be way more hoops to jump through, tons of repairs that are going to be required, and the seller is advised against that because of the timeframes and the issues associated with it. So first of all, I absolutely love veterans, okay? We want to take care of our veterans. We should care about these people and say, I'm going to advocate for you. So and a VA loan is amazing because they get to put zero down and they do not have to pay monthly mortgage insurance. There's no monthly mortgage insurance. And if they are a disabled veteran, they don't even have a funding fee, which means that upfront that gets added to the loan amount doesn't even exist. So this is a really, really great product. If you're using VA financing, the most important thing to remember is that your buyer cannot pay for the pest inspection, and a pest inspection is required. So get the pest inspection as quickly as possible. There's Section 1 and Section 2 items on the pest report. All Section 1 items have to be cleared. It depends on what the Section 2 items are, but if they're related to health and safety codes, such as mold or water damage or a broken pipe or a glass window that's broken, it's going to be called out to be repaired. So not all Section 2 items, but some of them can be. So if you get the pest inspection within 72 hours of being in contract, you're ahead of the game. It's not going to be an issue. It's not going to slow you down. You do a request for repairs. If the seller won't pay for it, you make sure your buyer knows, hey, these have to be done in order for you to be eligible for this type of loan. I'll do the same. So there's no reason why you cannot take a VA buyer and submit a loan offer with no loan contingency with a 21-day close. It's really just about managing that pest report. That's the only thing that's different. So if you know that ahead of time, you can really advocate for your buyers. Because if you submit the highest and best offer with a 21-day close of escrow, no loan contingency using VA financing, what's the difference? The only difference is not knowing those details. And if you do it as is, then we can talk about that and I can answer any questions you have on that.
Awesome. Yeah. So, I mean, and I love your passion for that. And I think the main thing to take away is, don't give in to the misconceptions about VA loans. Like you said, like we want to actually like back up what we talk about when we're thanking veterans for their service, because it's a great opportunity for them. And it's a bummer that it sometimes puts them at a disadvantage, and she has a great point that we can really change that. I was talking to a buddy yesterday who one day will be over here, but he's a pretty big producer, and he was saying how someone from the team wrote on one of his listings, and it was multiple offers and pretty competitive, and the person on our team was really, really close and essentially had almost the same exact offer as another agent The only difference was the main difference was the other agent's offer was a VA offer, and he went with the VA offer over the other one because it was an opportunity where VA worked. And I actually, you know, as bummed as I was that our team didn't get it, I was happy that, you know, being able to take a VA loan was an influencing decision on getting that buyer, because I do think that VA loans are underserved, and really we need to change that perception that, you know, that we don't want VA loans in our offers. So that's
Yeah.
awesome, and I like hearing more of that. So thank you. And if you hear, you know, you're talking to someone and you're talking to a lender and they sound like they're trying to steer you away from VA loans, like that's you know, talk to Patty, because clearly, you know, 21 days no loan contingency on a VA loan, like that's pretty awesome. So
yeah. They're super easy. It's a lack of education that creates those problems. That's all.
Cool. And then last type of loan, I just put in here like non-QM. That's basically like, you know, and every lender will have different options, but non-QM will be, you know, some weird program that people have for, you know, unconventional situations. So, you know, there's someone that has a ton of cash, but their income's weird because they just sold their company and they don't actually have, you know, regular income, or it's a certain type of property, or, you know, it's just a different situation. Like, there are some potential products out there for, you know, non-qualified mortgage. It's not, you know, people get scared when you talk about stuff like this because it reminds them of when people were just getting loans like crazy. But, you know, it's not easy to get these loans. They're just basically just, this is on here so you understand that if there is someone that has a weird situation, like they have a ton of cash or whatever, but, you know, their income situation is weird because of the situation they're in. And you see that in the Bay Area with like people with tech companies that are, you know, selling and things like that, like there are options out there for people. So getting up against it, I want to just put a little information about Patty here on the slide. We'll get her contact info. I think it was dropped in Slack yesterday. Again, she's made a pretty big commitment to support the team and send some leads our way. So definitely, you know, give her a chance. If it should be a very clear from spending just a little bit of time with her on the Zoom that she's somebody that if you can put in front of your clients or potential client, she's just going to make you look like even more of an expert, because clearly she knows what she's doing and at a very high level. So definitely.
Thank you so much.
Yeah, of course. Thank you. No, really appreciate your time being on here too.
If I can, I'll add to the non-QM really quick because QM stands for qualified mortgages. And if you ever heard of the phrase subprime and what they associate the crash of real estate for 2007 and 8 to, that is basically non-QM is the new subprime. It basically means that they're outside of what's known as a qualified mortgage. So it has a separate credit rating. Bank statements are used to verify income. That's absolutely correct. So if you have a guy who makes a ton of money but doesn't want to claim that income on his tax returns, we can use his bank statements. And then really, let's talk about that case by case when you have a scenario, because there are new guidelines with COVID that are required, you know, self-employed borrowers are taking a hit. So if you have a self-employed client, you really want to make sure that their loan and all of their paperwork has been analyzed completely before you take them shopping. If I can't warn you about anything else, let me warn you about that. It's really important.
Yeah, and that's always been the case because self-employed borrowers are going to be trickier. But with the things that have come up with COVID, and I've dealt with this a couple of times recently with my clients, it's with the COVID situation, unfortunately, it's gotten even tougher for self-employed borrowers. So if you have a self-employed person, really make sure that their qualifications and their approval is solid, because it can be pretty tricky just all the time. So last thing, we're obviously out of time, and I think that we kind of covered a lot. We covered a lot, so we don't really need to get into it too much, but I pulled this off of Patty's website. It's just the process. This is something I think overall people are pretty familiar with, and just kind of the steps in going through a mortgage. But, you know, it's important to understand that just like the home buying process, there is a process, you know, the application, disclosures, appraisal. We've talked about how appraisals work a number of times, and just going through, you know, the process of working with buyers, you know, loan processing, getting all the information, the underwriting process, and then, you know, getting the clear to close. There's some stuff in here like getting the closing disclosure out and the mechanics of signing that, you know, you're going to want to understand. I think we've talked about that a little bit and just talking about the process as a whole. But, you know, there's Patty's website. I think it's yourmortgagegirl.com. There's some good resources on there. And then obviously, you know, reach out to the leadership team, or I'm sure Patty's available to answer questions. And
yeah, let's always talk. You can do bookwithpatty.com. That's PADI, book with Patty. And the thing is that I feel like after all this time of doing it, there's not a single manual written that could ever teach you this business, right? These manuals and these terms and these training programs, what they familiarize us with are terms. You're never going to have two same scenarios in this business. Never. You'll have familiarities, but it'll never be the same. So anytime you want to talk about a scenario, let's just talk, because I want to make myself available to you. You know, it's a part, I'm really passionate about this business. It's literally the only thing I've done as an adult. And so educating you on it, I feel like makes the industry better as a whole. So when you want to talk about this process in depth or your scenarios in depth, I'm available to you.
awesome. Yeah. And that's huge, because that, you know, going deep in someone's situation might be the difference between you know, them making the decision to buy because they think they can't versus you making it happen for them. So understanding enough about knowing how to put the pieces together, and then connecting people, or at least, you know, maybe someone just thinks they have no chance, and you get some information about their situation and you can run it by Patty, and then you can actually go back to them and say like, hey, you know, if, you know, this and this, you could do it or whatever, then that might turn them from not wanting to even talk to a lender and try to, you know, going through and seeing what they can qualify for. Because really, like, I think in this industry and in this environment, I think a lot of buyers, especially first-time buyers, think that they need to like make the decision that they're going to buy a house before they talk to a lender or talk to a realtor. So the more that you can educate people, like, hey, like, you don't need to be committed to buying a house to approve, to see what you can qualify for, or to go, you know, talk to a realtor about what the market's like. And I always tell my clients, like, you know, you don't need to make, if you're still working on the decision of whether you want to buy or not, why don't you make that decision with a complete picture of knowing what you can qualify for, knowing what's out there on the market for that price that you can qualify for. And if you know, once you see what it would really look like if you decided to buy a house, then you can decide if you want to do it or not. But don't like put it off because you don't think you can do it and you don't want to like take those steps to get all the information. Because if you're deciding, you know, if you're not making the decision to buy a house without all the information, like you're essentially like just doing yourself a disservice. So really trying to get people to understand that, you know, lenders and realtors, the good ones, are there to be resources. We're passionate about making people get into homes. We're not just chasing checks. And, you know, we do this job because we love facilitating the process of getting people into homes. So the more you can get resources to people, the more it's just going to get you business. And the more you kind of come from a place of service, and the more people can genuinely see that you're just trying to facilitate something that they want and maybe think is difficult, the better you're going to be at this job. So really appreciate your time, Patty, and everyone on here. This is super helpful. And again,
I'm sending you all big hug energy because I'm a hugger. So This is hard for me.
looks like Will's trying to hug down there too. Will, what were you and Pete doing? You guys look like
they're trying to say hi. Hi, Pete. Hi, Will.
Yeah. Oh, Will and Pete, they're working. They're submitting an offer, I think, on a lead from you today.
Hi, Patty. Hello, Patty.
They are super well qualified guy, 800,000 in the bank. You know, they're good. They're good to go. You guys are golden. Let's kill it.
Let's kill it.
Team Fast.
That's due today, right? Or
I
no?
always listen. I used to always say, "Hi, I'm Patty Goodspeed, and I like things done yesterday." You see, this is a match made in heaven.
And that was I was in the car with my wife when I was on the call yesterday, and she's like, Goodspeed, and she's working with Team Fast. Like, it could not be any more perfect. So.
Hello.
Yeah, that's awesome. Karina, I saw you on mute for a second. Did you have anything you wanted to add? Karina's busy working away. So, okay, cool. All right. Well, Patty's information is in Slack. Like I said in the beginning, it's super important that you have a good lender partner. So if you don't have one, start with Patty. She's clearly super, super sharp. and we'll help you get deals done and convert leads. So
Let's do it.
make it happen. Lean on the team, lean on the resources you have. Thank you for coming to training today, and thank you again, Patty, for taking so much time out of your day. We appreciate it.
My pleasure.
All
Talk
right.
to you soon.
Have a great day, everybody. Sarah, you guys are muted. What up? You're still muted.
Hello. Hello.
How you guys doing?
Hey John, let's ride things.
You're right, dude. I'll hurt myself so bad.
I thought we were golfing.
If I'm gonna risk hurting myself, I'm gonna ride a mountain bike. I'll blow my knee out on a fixed gear right now. You're golfing.
I'll be right back. Hey John, what you know about Andrew Lowe?
Andrew Lowe?
Yeah.
I don't think I know Andrew Lowe. Who is he?
He custom builds frames and SF.
Oh, nice. No, I don't know Andrew Lowe. I've been out of the game for a while too, and I was never really into the whole like fixed gears much. Because I couldn't really ride them very well. But
You ride mountain bike?
What's that?
You ride mountain bikes?
No, well, yeah, I rode mountain bikes and road bikes but I worked at a bike shop for like 10 years. Not in a shop, but I worked in the bike industry for like 10 years.
Are you a bike mechanic?
Yeah, right, dude. When the mechanics would see me working on my own bike, they would just like take over. They're like, we don't want you to hurt yourself. I mean, I could build a bike. Like I could build a bike from scratch, but like I can't do everything. But I could, I got some skills. It's been a little while.
Peter said he needs a bike mechanic.
Yeah, he doesn't want me to work. I don't want that kind of liability when your crank arm falls off again.
Hey, I thought we were gonna go golf, dude.
Yeah, let's do it. When are we gonna do it?
I'm gonna embarrass you, but you're just gonna have to take me to like the ghetto type golf course.
Well, I know that's when Kevin was trying to say like, oh yeah, Peter's down too. I'm like, dude, I'm not trying to use one of Laura's private country club spots on Peter when he barely knows what he's doing. Like, I'm down to golf with you, but not in a prime spot like that. There's a 9-hole course in San Leandro that's like a awesome. I really like it, and it's a good spot to like start out at.
Yeah.
But we should do it.
I'm a natural. I'll be okay.
Oh, dude, I'm sure. Like Asian people are great at golf.
Congrats, Juanita, on your new escrow.
Oh, Juanita going in escrow? Juanita hasn't even been paying attention for the last hour since her phone's just logged in somewhere. I'm just kidding.
Just sitting there smiling.
All right.
Later, homie.
What happened with that offer, Peter?
We're offering it now.
I thought it was due yesterday.
Nothing.
No. We have till another hour.
Wasn't it due yesterday?
I thought it was, but it was today.
Because I was getting the updates too. I guess I was wrong. Maybe I'm thinking of something else.
Yeah. No, we're only up against 2 other offers. I think we're coming in pretty strong. There was just a lot of like client management. They were just going through ups and downs, like literally moving their offer by like 70 grand, 80 grand, like at a time, back and forth.
Yeah, I mean, that's normal. Like everything seems crazy when you haven't done it as many times, and then you realize that like people are just crazy. What'd you end up doing with inspection contingency?
We're just doing the detached garage inspection now. 7 days.
Oh yeah, well, it doesn't even matter. So you have 7 days for whatever you could do like.
Yeah, but they kind of do like the big foundation one, but they just told me that like right now, and there's just no way without dragging it further. Just telling me.
Call until you got your offer accepted.
Yeah, I hope so too.
All right, cool.
Hey, John, what do you got going on today?
I gotta go to the Concord office at 3. But I'm gonna be here until for the next like 2 hours.
You wanna
Come on,
jump, you
bro.
wanna jump on a call like at 12:30?
What's that?
You wanna jump on a call around 12:30?
Yeah, that sounds good.
You got time?
Yeah, for sure.
Nothing urgent, if you got other shit to do, I get it.
No, perfect.
Alright, cool, I'll hit you up at 12:30.
All right, sounds good, Dan.
So.
All right, peace.